Welcome to The Explainer. Today we are breaking down an expert's blueprint for building a seriously powerful stock portfolio. We're going to show you how to blend that aggressive growth you want for the future with the steady income you might need, right now.
So let's dive right into the classic investor's dilemma, right? Do you chase those high-growth stocks to build your wealth for the long haul, or do you zero in on dividend stocks for a steady income stream today? It always feels like you have to pick one. But what if you didn't have to choose? Here's how we're going to tackle this. First, we'll really lay out the problem. Then, we'll pull back the curtain on the experts' three-part screening method they use to find these elite companies. And finally, we'll actually build this portfolio piece by piece, pillar by pillar. Okay, so let's set the stage for our main challenge. It really is about finding stocks that can serve two masters. You want that capital appreciation, the share price going up, but you also want those reliable dividends, that income hitting your account. And the expert report we're digging into, well, it tackles this exact problem. The whole point is to create a finely tuned 5-stock portfolio using a super rigorous, data-driven process that aims to get you the best of both worlds. So how in the world do you sift through thousands of stocks and somehow land on just 5? Well, it all boils down to a really disciplined 3-part screening method. Let's take a look at the 3 key metrics these experts swear by. Okay, first up, the number 1 filter is all about quality. The experts won't even look at a company unless it has an excellent rating for durability. Think of this as a signal that the business has a massive competitive moat around it, protecting it from rivals. These are companies that are truly built to last. Next, they hunt for value, and they use something called the PEGY ratio. Now, this is a fantastic metric. You can think of it as a stock's deal score. It's brilliant because it tells you if the price is fair based not just on its growth, but on its dividend, too. If you see a score under 1.0, that's a huge flag that you might be looking at a bargain. And the final piece of the puzzle is compounding power, and they measure this with return on equity, or ROE. This is basically the company's report card. It shows you how good the management is at taking your investment and turning it into actual profit. A high ROE? That tells you you've got an A student at the helm. Now, here's where this whole method really proves its worth. It weeds out those stocks that look tempting on the surface, but are actually pretty risky. Take PDD, amazing growth and value scores, right? But it fails the quality test because of high geopolitical risk. Or look at Uber. That PEGY ratio looks great, but its high debt and just a fair quality rating mean it gets cut. No exceptions. All right, so we've got our screening method down. Now let's actually start building this thing. We're going to begin with the first pillar, the pure growth stock. This is the engine of the portfolio. And the expert's pick for pure growth is, no surprise here, NVDA. Its dominance in AI isn't just about making the best chips. The real secret sauce, its real moat, is the proprietary CUDA software. This ecosystem makes it incredibly painful and expensive for any customer to even think about switching to a competitor. They're locked in. And this chart just says it all. I mean, look at this. NVIDIA's forecast return on equity is nearly 55%. That absolutely crushes the industry average of just 11%. This is what world-class efficiency looks like in a single picture. It's just on another level. And that incredible efficiency, it translates directly into just explosive growth. We're talking about revenue expected to climb almost 23% a year. That blows right past the high-growth benchmark of 20%. This right here is the engine. Okay, engine's in place. Now for the core of our portfolio, the beating heart. These are the high-quality compounders, the stocks that beautifully blend growth, value, and income to give us a super reliable foundation. So this core is built around 3 absolute titans: Microsoft, Qualcomm, and JP Morgan. Each one plays a slightly different role. You've got Microsoft, the definition of a safe, growing compounder with a monster ROE. Then there's Qualcomm, a tech leader that not only gets an excellent quality rating, but also has a fantastic PEG of 0.7. That means you're getting quality at a great price. And finally, JP Morgan gives you that exposure to the massive scale of the financial sector, also with a great PEG of 0.7. It's a perfect blend. But let's just zoom in on Microsoft for a second. Its real genius is its financial discipline.
See, it only pays out a tiny fraction of its profits as dividends. What about the rest? Well, over 3/4 of its earnings get plowed right back into the business, where they generate a phenomenal 32% rate of return. It's a self-fueling growth machine.
Now, to balance out all that growth, every good portfolio needs an anchor, a defensive stock that's going to provide stability and a rock-solid dividend, no matter what kind of craziness the market is throwing at us. And for that job, United Health is pretty much the perfect fit. It's got this rare, incredible combination of strengths. You get an A+ for dividend safety, that's the highest rating you can get, and you combine that with aggressive double-digit dividend growth. And with its super low volatility, it really is the portfolio's anchor in a storm.
Okay, we've looked at the engine, the core, and the anchor. Now let's put it all together and see what the final balanced portfolio actually looks like.
The recommended strategy is really simple and clear. The bulk of it, 60%, goes to that high-quality compounding core. Then, that's balanced out with 20% dedicated to pure growth with NVDA, and the final 20% goes to our defensive anchor, United Health. And what you're left with is this really elegant, equally weighted 5-stock portfolio. Each company makes up 20%. Each one has a distinct, vital role to play, and together they create this powerful synergy between growth, quality, and stability. So look, the big takeaway here isn't just the 5 company names on the screen, it's the powerful and disciplined method used to find them. It's a framework that is just relentless in screening for quality, value, and efficiency. And it's a blueprint you can use to think about your own strategy, which really just leaves us with one final thought. Now that you've seen the framework, what would your ideal portfolio look like?